Hey, what's up guys? Welcome back to the channel and I hope you're all doing well. In this video, I'm going to give you my stock picks for the month of August. I'm going to go over 5 stocks that are my picks for the month from the hundreds of stocks that I have looked into that trade on the TSX. I'm going to go over their recent financial figures, their valuation metrics, and provide my full analysis on why they are my picks for the month. So make sure you watch the full video. I'm also going to provide recent business updates so you know exactly where these stocks are potentially headed next. There's so much to talk about. Let's jump right in. First up, Metro, ticker symbol MRU. If you take a quick look at all the industry sectors in 2021, you'll find there's been one sector that's been among the top performers, and that is consumer staples. As the economy shut down, we still needed our necessities. In fact, there was so much panic buying. This sector remained strong throughout the lockdowns and is still strong today, especially among the grocery stocks. And one of the country's best grocery stock is Metro. Metro is a pillar of consistency, nothing flashy, just consistent and reliable growth. And that's exactly what you want to see as a dividend growth investor. Consistent and reliable growth. Although the company's low yield may be a turnoff for some, but this is one of the best dividend growth stocks available in the country. Metro is currently trading at $61.92 and has a market cap over $15.2 billion. A PE ratio of 18.80, earnings per share at 3.29, and a dividend yield of 1.61%. It pays out dividends on a quarterly basis in February, May, September, and October of each year. The payout ratio is 28.12%. The most recent dividend was 25 cents per share. Looking at the 3-year dividend growth ratio, it's at 9.52%, and the 5-year dividend growth is 11.97%. Taking a look at MRU's financial performance, you'll notice on the company's latest quarterly results that everything from revenues, net income, diluted EPS, profit, margin, and operating income, it has seen strong growth as Metro continues to benefit from a recovering economy. Indications are that Metro will be able to continue to increase its earnings per share over time. The last dividend increase was 12.2% per share. This marked the 26th consecutive year of dividend growth. It has a return on equity at 13.6%, a 5-year performance of 30.65%, and a 1-year performance of 6.3%. When you take a look at the analyst recommendations, MRU is a mix between a buy and a hold and has been moving towards a hold since April. However, in my opinion, this to me is a buy. The company is involved in various projects, including over $420 million investment over the next 5 years for the construction of an automated distribution center in Montreal. They are focused on sustainability, focused on growth. This is exactly what I like to see as a dividend growth investor. Signs for long-term growth ahead. In my view, when it comes to TSX, Metro is not only a safe play, but also an excellent dividend growth stock, especially in a post-pandemic recovering economy. There is so much demand for e-commerce and online grocery shopping, and Metro is an icon in this industry. And this is exactly why it should be an anchor in your portfolio. Metro Supermarkets, Super C, Adonis International, and Food Basics are among its reputable grocery store banners. Organic expansion and customer convenience are its top priorities, and this is exactly why it's my pick for the month of August. If you're new to the channel or you've seen my content before, do me one huge favor. Hit that like and subscribe button. Why? Because it does 2 things. 1, it lets me know to produce more content like this, and 2, you don't miss out on future stock picks. Next stock up is Restaurant Brands International, ticker symbol QSR. Restaurant Brands International, or RBI for short, is a Canadian-American multinational fast food holding company. It owns some of the most recognized names in fast food: Tim Hortons, Burger King, and Popeye's Louisiana Kitchen. RBI is uniquely positioned to see superior growth. Why? Because of its established brand names and its unique value proposition. It owns and operates over 27,000 restaurants across the globe, over 100 countries. To me right now, RBI looks incredibly cheap, especially if you believe in Canada's economic reopening plan and the broader global reopening plan, because now more and more people will be allowed back into restaurants to eat in their establishments. RBI had fallen out of favor because of COVID-19 as restaurants globally were shut down, but that is the exact type of businesses great investors like Warren Buffett seek out in times of turmoil, because it's generally temporary until they see a rebound. RBI is currently trading just over $82 per share. It has a market cap over $25.1 billion, a PE ratio of 38.38, earnings per share at 2.14, and a dividend yield of 3.19%. It pays out dividends on a quarterly basis in March, June, September, and December of each year. Although its payout ratio based on earnings is at 122%, if you take a look at its cash flow based payout ratio, it's a more sustainable 51.85%. Its most recent dividend was $0.53 per share. It has a 3-year dividend growth rate of 18.96% and a 5-year dividend growth rate of 36.2%. In terms of its financial performance, as more and more economies have opened and are reopening, you can see the favorable impact on RBI's financial performance. Revenue, net income, earnings per share, profit margin, operating income are all up on a year-over-year basis. Investors seeking an excellent pandemic reopening play have a top-notch pick in Restaurant Brands International, and I'm anticipating this stock could go on a very nice run once the dust settles. It has a return on equity at 20.56%, a 5-year performance of 40%, and a 1-year performance of 7.5%. Looking at the analyst recommendations, QSR is a mix between a buy and a hold, with a lean towards the buy side. This stock is currently trading below the high price target, meaning there is still some potential upside in terms of capital appreciation. But don't forget, with this stock, you are targeting great dividend growth more than anything else. This is a top stock on my watch list right now. Long-term investors seeking companies providing dynamic growth can't go wrong on this one. This is a company every dividend growth investor should check out today. RBI is also focused on a more sustainable tomorrow. Their restaurants generate so much waste because of packaging, and that's why they're looking to launch a green packaging pilot program. Cutlery will be plant-based plastic, and so will the straws, and the paper napkins will be made from 100% recycled fiber. This action alone is the equivalent of removing 910 metric tons of greenhouse gases per year. This is so incredibly important. Just think of all the fast food garbage that ends up in our landfills and just stays there. Reducing overall packaging to a more sustainable option should be the goal of all food providers. RBI is a solid business with a great strategic plan, and the payout ratio is safe. And there is so much room to grow, and that's why it's my pick for the month of August. Next stock up, Royal Bank, ticker symbol RY. Royal Bank is an iconic Canadian name that needs no introduction. At the time of filming of this video, it is the largest Canadian public company on the TSX. This stock is up around 20% on a year-to-date basis, and even then, I still think it's a buy. As a dividend growth investor, you want consistent dividends, you want consistent dividend growth, and because of COVID-19, some companies were forced to cut their dividend. But with RBC, there was no dividend cut. After reporting its Q2 2021 results, it had more than $10 billion in excess capital, and this will be used to increase their dividends very, very soon, and you can bank on that. If someone asked me today, how would you invest $1,000 right now? Hands down, I would pick RBC. It is Canada's most valuable company, and it's focused on delivering a premium return on equity and earnings growth for all RBC stakeholders. RBC is currently trading at $125.86. It has a market cap close to $180 billion, PE ratio of 12.79, earnings per share at 9.84, and a dividend yield of 3.45%. It pays out dividends on a quarterly basis in January, April, July, and October of each year. It has a payout ratio of 43.90%, and its most recent dividend was $1.08 per share. It has a 3-year dividend growth rate of 5.18% and a 5-year dividend growth rate of 6.45%. Taking a look at RBC's financial performance, the year-over-year results speak for themselves when looking at its latest quarterly earnings. Triple-digit growth in net income, earnings per share, and operating income, 56% and 73% increase in revenue and profit margin. This is a mega corporation that makes mega money for every single shareholder. RBC can leverage the company's scale, strong risk and capital management, and diversified business mix to drive long-term growth. It has a return on equity at 16.09%, a 5-year performance of 58%, a 1-year performance of 34%. Looking at the analyst recommendations, RBC is not a mix between a buy and a hold, it is just a buy. When you take a look at the price target, this is a screaming buy. With the current share price below its lowest price target, there is just so much upside when you look at the highest price target of $145 per share. RBC recently launched a brand new innovation hub in Calgary with plans to expand technology roles in high demand areas. This just shows you that even with the size of RBC, they're looking to grow and they're focused on high growth areas. RBC is not only Canada's largest bank, but also one of the largest banks in the world based on market capitalization. And they have a well-diversified business model where they focused on innovation and growth. And now that WealthSimple offers fractional shares, if you don't have enough capital to buy one share of RBC, you can now buy fractional shares in Canada's largest bank. RBC is an ideal holding for long-term investors. It has an amazing track record, and that's why it's my pick for the month of August. Next stock up is SmartCentres Real Estate Investment Trust, ticker symbol SRU.UN. The Canadian REITs have been slow to recover from the 2020 stock market crash because of COVID-19. Many harder hit REITs have bountiful yields and are well equipped to hit pre-pandemic highs once the economy starts to recover. One of those names looking to make that rebound is SmartCentres REIT, and this is a screaming bargain, especially if you're looking for a high yield REIT. If you're looking for monthly dividend income, a degree of inflation protection, SmartCentres is a great pickup. Honestly speaking, I wish I had picked up more when the yield was near double digits. SRU is currently trading at a price of $30.17, a market cap over $5.1 billion, a PE ratio of 60.46, earnings per share at 0.5, and a dividend yield of over 6%, coming in at 6.12%. This REIT pays a dividend on a monthly basis every single month of each year. And depending on where you're getting your information, this REIT may seem like it has an abnormally high payout ratio at 437%. But you need to ignore this because this is not real. REITs payouts are based on FFO, funds from operation, which is currently at 89%, and it's incredibly safe. Its most recent dividend was 15.4 cents per share. It has a 3-year dividend growth rate of 2.16% and a 5-year dividend growth rate of 2.58%. Taking a look at SRU's financial performance, you will still see some mixed results for SRU on its last quarter as major retailers still face heavy restrictions. This is why this is such an undervalued pick. As more and more restrictions are lifted, more shoppers will be visiting major retailers located within SmartCentre plazas. Rent collection is near normal, and there's a chance that shares could overshoot as we exit the pandemic into a roaring 20s kind of environment. Shopping centers are not dead yet. In fact, they are thriving. So much so that SRU shares could soar above 2020 highs by the end of 2021. It has a return on equity of 1.64%, and although it has a negative 5-year performance at 21%, its last year 1-year performance is 48%, and I still think it's a screaming bargain. Look at the analyst recommendations. SRU is rated down the middle between a buy and a hold, and the price target is between the low and the high targets, right around the average. All this means is that SRU is on its way to a strong recovery as more and more retailers are welcoming back shoppers. This all translates to better rent collection. You can very well be a lazy landlord with this top passive income rate. Just sit back and collect your piece of the rent checks from major retailers like Walmart, Costco, Best Buy, just to name a few. If you think SRU or SmartCentres REIT is just a shopping center REIT, you would have been right a few years ago. But this REIT is evolving. As part of SmartCentre's evolution, they're going from shopping centers to city centers. As Oakville, Ontario grows, its new uptown core at Dundas Street and Trafalgar Road is set to become a multi-use center. SmartCentre's 52-acre site along in the core of Oakville, Ontario aims to become a new urban heart of the community through a multi-phased master planned redevelopment. The first phase of this new community includes a pair of 28 and 29-story towers. A combined 585 residential units are proposed in the first phase of the community. And if you know anything about Canada's hot housing market and the potential from SmartCentre's evolution, you know exactly why SRU is my pick for the month of August. This last stock up is a name that does not get a lot of coverage, and that name is ECN Capital, ticker symbol ECN. ECN Capital's management team has built a robust specialty finance business platform that has prospered and delivered maximum return to shareholders. ECN Capital is not a small entity by any means, especially if you've never heard of them. They have a market capitalization over $2 billion, and they also have another $33 billion of assets under management. This is a very experienced team that's looking to grow. If you're looking for a growing asset manager that's trading around $10 a share, this is something for you to consider. To me, this is a very undervalued pick, and there is so much room and potential for growth just by expanding the company's existing product line. It's currently trading at $10.15, has a market cap over $2.5 billion. It had an earnings per share less than zero, having improved to 0.08 in the last quarter. The dividend yield is 1.19%. It pays dividends on a quarterly basis in March, June, September, and December of each year. If you look at the payout ratio, it's currently over 267%, but that's based on earnings. If you take a look at the payout ratio based on cash flow, it's considered to be safe. The most recent dividend was 3 cents per share. It has a 3-year dividend growth rate of 38.59%. Take a look at ECN's financial performance. They have seen amazing growth in the last little while. Keeping in mind, this company has only been around since late 2016. ECN has strong Q1 results across each of the businesses. This is a company that's on growth mode and pays out a growing dividend. The return on equity came in at 9% in 2019 and is expected to come in around 17% in 2021. And right now, that return on equity is at 11% and it is poised to grow. It has a 5-year performance of 193%. That's a tripling in the stock price in the last year alone. Over 133% performance. Taking a look at the analyst recommendations, ECN Capital is a major buy based on most analysts. It's rated between a buy and a strong buy. It has absolutely grown past expectations, having recently blown past its highest price target. This is not your average dividend stock. It's a hybrid growth stock that also happens to pay a dividend. Plain and simple, this is a high risk, high reward dividend growth stock. ECN Capital is a leading business service provider to major North American banks, credit unions, life insurance companies, pension funds, and investment funds. It also offers advisory and management services. ECN Capital serves over 100 financial institutions, ranging from some of the largest US-based banks and credit unions to community banks and local institutions. ECN's businesses are leading in the areas that they serve. And this is a little known fact that ECN Capital is also a dividend aristocrat. Its last dividend raise was 11% and has grown its dividend by more than 35% CAGR in the last 3 years. This company continues to focus on innovation and asset management growth, as well as broadening its partner relationships. And that's exactly why this is my pick for the month of August. Thank you so much for watching. This channel would not exist without your love and your support. If you've enjoyed this video or any one of my other videos, consider hitting that super thanks button on the bottom of this video. It's a new way to directly support your favorite content creators on YouTube. Or if you'd like, you can buy me a virtual coffee as another way to support my content and the channel. All proceeds will be used to bring you even more value-added content that I hope will leave a lasting impact on your investing journey. So if that sounds good to you, check out the link in the description of this video to buy me that virtual coffee. And on that very same page, you can download my custom-built Excel-based dividend portfolio tracking spreadsheet, which I use to track my own dividends, forecast my dividend income, and track my gains. So you can keep track of your portfolio exactly the same way I do. If you have questions for me, feedback on this video, or maybe you have ideas on future content, let me know your thoughts in the comment section. And while you're at it, make sure you've hit that like and subscribe button or that thanks button. That's it for now. I'll talk to you in the comment section.